Welcome back. I'm here today with Rusty Braziel, who is the CEO of RBN Energy and also the author of the new book entitled The Domino Effect. Rusty, welcome to the show.
Thank you, David. Good to be with you.
Oh, good to have you. First of all, your book, The Domino Effect, covers an in-depth analysis of both natural gas and crude oil and how oil prices become affected by market factors. Let's start there so our audience understands the factors at play in the industry.
Right. Of course, it's all about supply-demand, right? So when supply is too high, if it's more supply than the market can absorb, prices go down. Prices will go back up either when demand responds and demand increases or when supply drops. So a lot of what folks are waiting for these days is when and if supplies are going to drop, and presumably that would increase prices back to maybe not where they were, but certainly above $30 or $40.
Now, some of this, of course, is on the demand side. I know there's been a lot of publicity lately about the supply side being problematic, the fact that especially Saudi Arabia keeps pumping oil. But the demand side also is a recent report just about a week ago that said that OPEC is actually predicting a reduced demand for oil products. So how much of this do you think is demand side versus supply side?
Well, I would say it's 75 or 80% supply side and 20% demand side. So what's happened over the past few years is that the United States shale production has increased substantially, 5 million barrels a day or so. Because of all of that increase in supply, for at least some period of time, there was enough increased demand in the world to absorb it, most coming from China. When the Chinese economy started to slow down and U.S. production kept increasing, that's what finally pushed oil prices over the brink, if you will, and drove prices down below $30.
Now, it's interesting because the demand side argument has been China, as you just mentioned, but the other part of it is that a lot of people have speculated that the reason that oil prices are dropping in part is because it's a symptom of some type of deflation that seems to be right around the corner. Any thoughts on that?
I'll be honest with you, I'm no expert on inflation and deflation. I think I'm an expert on oil prices and oil markets, and what's going on in oil markets is in fact not surprising at all. As you said, the book is about both natural gas. It's also about natural gas liquids, propane and butane, that are also big parts of this market. So 6 or 7 years ago, the shale phenomena, what we call the shale revolution in the United States, came to natural gas. When it came to natural gas prices crashed, and they've stayed low ever since. For a few years, producers started to shift their drilling budgets to drill for what's called wet gas. Wet gas contains lots of natural gas liquids, propanes and butanes, and production increased for those commodities for a few years. And guess what happened? Exactly the same thing. Production increased and prices crashed. It was just inevitable that the exact same thing would happen to crude oil. That's what has happened. So in other words, this is not anything surprising or anything new. And that's what the book talks about, the fact that this is all happening for a series of reasons, and those series of reasons can not only be understood, they can be predicted.
Great. How much of this do you think has to do with how speculators deal with oil? I'm referring to the recent price drop. You know, it's interesting, the stock market, which is more the side I usually focus on the show, the stock market is, most people, 90% of investors or so are long in stocks. Very few people are actually short. But in the oil markets and the way it's traded in the futures market, as you well know, for every person long, there has to be someone short. And as a result, when your fulcrum is right in the middle, it seems like if something gets out of whack by just a little bit, it can have a more profound effect. To what degree do you think that plays in with the degree to which we've seen recent volatility in prices?
It's been a big factor. So what was happening back about 2 months ago up until maybe 3 weeks ago was that every bit of bad news came into the market, and most of the news that was coming into this market was bad. Very high inventories, Saudis pumping more, Iran coming back into the market. The shorts got into the market and pounded it down. So the market never should have really dropped based on fundamentals down below $30, down to 26 bucks. It never should have happened that way, but it was the shorts that basically caused the market to overreact. Then when we started getting a little bit of good news, when we started to see the noises being made from OPEC and Russia about the possibility of some sort of deal, when we started to hear a little bit of good news about demand, then the shorts got spooked. They closed out their positions, made a lot of money, by the way, and prices started to run back up as they closed those positions out. So a lot of the exaggeration that we've seen in the market, not only driving down below 30, but frankly, right now, driving back above 40, it's happened because of those financial players.
You know, with fracking and with shale, you know, how much more capacity do we have as a country? How close are we, in your professional opinion, to becoming energy independent?
That is a very hard equation to calculate because energy independent, well, does it include gas, natural gas? Does it include natural gas liquids? Are we only talking about crude oil? Now we're exporting crude oil. The reality is that we're still importing a significant amount of the crude oil that we use. A lot of that crude oil comes from Canada. So are we going to say that we're going to stop importing crude oil from Canada? That's pretty unlikely, if that's your definition of energy independence. So the real answer to it is that if you include all of North America and if you include all hydrocarbons, we're not far away from energy independence right now. But if you're only talking about crude oil and you're only talking about crude oil that we produce in the United States, and that's your definition of energy independence, it's a long way away.
Okay. Do you think, as a final question, do you think we're closer on the oil side to that energy independence or closer on the natural gas side?
Oh, natural gas, we are already there. And the first cargo of liquefied natural gas left Cheniere's dock just a few weeks ago. There'll be a lot more liquefied natural gas being shipped out of the United States. We can produce more natural gas in the United States that we can use. As a matter of fact, we are doing that right now, and that's the reason prices for natural gas are as low as they are. So we're already there on natural gas. We're already there on natural gas liquids, propane and butane. Only crude oil is the commodity where we're still importing significant barrels.
Rusty, that's been great. I've learned a lot. I thank you very much for being on the show today.
Thank you.
And go out and purchase the domino effect. You know, to me, this concept of energy independence is so important. I'm surprised it's not even more of a political hot button in the elections we're looking at right around the corner. Stay with us. We'll be right back.